Hello, everyone. Good morning.
Good
And because
morning.
morning, everyone. All right, a few housekeeping rules. Just if you could please make sure that your mics are muted so we don't disrupt the class and interrupt our speaker. Namdi is also going to do a check on us in case anybody joins and forgets to do just that. So we're going to jump right in because we have a lot to learn and a lot to cover. So like I said, good morning, everyone. My name is Hannah Swadiboiga. And on behalf of Marketplace Alliance, that's the department in this present house, we are honestly delighted to have you here. It promises to be an insightful and very practical session for some of us that really don't understand how the new tax regime is going to affect us. This is the right place to be. So as I just mentioned, our topic and our theme today is the new tax regime and how it affects you on an everyday scale. It's very timely, it's very necessary because, like I said, a lot of people just don't get it. And we're seeing a shift in how taxation is being structured, how it's being enforced, how it's being experienced. And for many people, it's been very far. Traditionally, tax has been very far, especially for us that work with 9 to 5, or we have 9 to 5s. It's been handled by the office. So we've not really had an idea of, the nitty-gritty behind it. But for some people, especially business owners, they've understood it. Some of us, it's still new to us. So the fact that things are changing means that we need to sit up and understand it better. So today, it's now more personal, it's more strategic. And ultimately, we're seeing how people are using taxes in their businesses and in their livelihoods to preserve their wealth. So that's something we need to learn. So what we hope to get out of this session, and that's really what we've curated it to be, is to provide clarity on what's changing, help us, all of us, understand how these changes affect you, what it means for you and how it affects you, and then most importantly, how we want to be guided in the future and how we can do things differently. And we're honestly thrilled, really thrilled, because he's a really busy man, to have our speaker. He's a distinguished expert who operates specifically in tax policy, strategy, and execution, Mr. Kenneth Erikume. He is the country operations partner at PwC, so we work for the big guns. And he also serves as the head of tax reporting and strategy for the West African markets. He has an extensive experience advising organizations and shaping tax interpretations across markets, and he brings not just knowledge, but perspective on what's practical and forward-looking. We are very privileged to learn from him, but before I hand over, I just want to kind of give you a flow of how it's going to run. Our speaker is going to do a presentation, first of all, and then we're going to have an interactive session of Q&A. So if you have any questions, please feel free to drop them in the chat box throughout the session. Inamdi and I are going to be monitoring the chat, both on YouTube, both and on Zoom. So we're going to pick up your questions and we're going to ask him once the presentation is done. Please make sure your mics are muted just so we don't distract and interrupt our speaker as well. Please be engaged. There's a lot to learn. There's a lot of value that we're going to learn here, and we really want us to be able to know how to apply this going forward. Without much ado, let me hand over to Mr. Kenneth Erikume. And if you could please just give him virtual claps. Thank you very much. I see Wofi has already doing that. Virtual claps. Just let him know he's really welcome. Fantastic. He's already sharing screen. Fantastic. Mr. Kenneth, over to you.
Right. Thank you very much, Hanatu. Good morning, everyone. I hope you're enjoying the holidays. But just right in the middle of holiday, I think people are trying to understand the tax law, so holiday can wait for a few hours. It's a difficult job to run through the tax reforms in 35 minutes, but I'll try my best to do as much as I can. And I'm sure that most of the engagements will then be in the Q question and answer session, where we can then engage a bit more. We can get personal, we can get into the detail, and you can ask your specific questions. All right, the context from the government's perspective, what is the government trying to achieve, right? The tax to GDP ratio of Nigeria is very low. So some people put it at 13%. My calculation puts it at around 10% tax to GDP. GDP is a measure of economic activity. It means that, within the economic activity of Nigeria, government is only able to generate 10% of that as revenue. That's an anomaly because when you compare that to other countries, even countries in Africa like Ghana, Kenya, South Africa, who are doing 14%, 16%, above 20% respectively. It shows you that Nigeria is not able to generate the needed level of revenue. And why is that so? It's so because historically, the government has focused on a few taxpayers. And this was one of the things that used to discourage people to become compliant, because they feel like when they become compliant, come into the tax net, then government will continue to tax them. So government did not have the ability to expand the tax net to capture the economy of those who were essentially not complying. And so if you look at the vision of what they've tried to do with these tax reforms, they've tried to use data as the currency to expand the tax net. So many of the discomfort you were seeing on social media, where people were saying, they will debit my account. Do I now need to put narrative, in the transaction when I'm sending a transfer, and so on and so forth. That discomfort was coming from provisions in the tax reforms that are, a bit intrusive in terms of data. One of them is the requirement for a bank or other financial institution in every month where the transactions in an individual's account is 50 million and above to report it to the tax authority. And for corporates, if it is 250 million naira and above in a month, where the transactions in that account is more than 250 million, then the bank or other financial institution, which could be insurance, it could be, investment bank, it could be anything, would have to report that information to government. Now, if on the one side, you called it a gift, right? So it came into your account as a gift, that's the narrative you put, and that's the explanation you gave. Do not forget that on the other side, that transaction would also be reported. So if it was sale of a property in Ikoyi, for example, that person would have recorded it, as a purchase of property. So you giving the narrative of a gift would show that there is a misalignment. So government would have a full 360-degree picture of transactions. The other one that government is also trying to do, has already started implementing, is what they call e-invoicing. And there is a first wave, second wave, and a third wave. The first wave is for companies with, annual sales or turnover of 5 billion. Those ones are already required to comply with e-invoicing, and penalties will begin to apply anytime between April and June. The government will begin to penalize. Now, what's the requirement? The requirement is that your accounting system or your ERP system, which you use to generate invoices, has to be plugged in such a way that it sends the information of every sale to the government's portal, where the government will now sit with the data and can tell how much sales a company has made. And do not forget that the sales from one company or one business, let me not use the word company, is the purchase in the other side. So government can then have a full 360-degree picture there as well. The other one that government is working on is, and you would have seen this a lot of times, which is the tax ID, where they say you cannot operate a bank account without a tax identification number. Apart from that provision, there's also another provision that says that for a business, if you transact with someone that does not have a tax identification number, then you are exposed to a penalty of 5 million naira. Now, let me put that in context. If your business did very well, right, in a particular year, and then you throw an end of year party, and then you call an MC to come, or a comedian or a performer to come and, perform in that end of year party, and you maybe the fee is 4 million naira. There's a requirement for you to get the tax ID of that person. Otherwise, when the government comes and they see that you've paid 4.5 million to that person, but the person does not have a tax ID, they will require a penalty from you of 5 million naira, which is even above the income or the agreement with that entertainer. So through that means, and some of these things, government can then use the compliant and bigger taxpayers to then bring the non-compliant and informal sector into the tax net. And these things has ramifications, for corporates and businesses across. So if you're compliant and large volume taxpayer, you know that technology and data and the consistency of your data is now very important. How you keep documentation of your business, the sales that you're making, the purchases that you're making, the payroll, the third-party evidence, all of those things are important in order to avoid penalties from the government. For tax evaders, it becomes very hot, right? And perhaps one of the reasons why there's a lot of discomfort, because to be honest, between you and me, the tax culture in Nigeria is not very strong. And there could be debates around this, to say, well, government has not provided the much required infrastructure. I am providing my water, I'm providing my electricity, I'm providing my security. So why am I paying taxes, right? And the counter argument would be that if you do not pay your taxes, government cannot provide all of these things. And then becomes a chicken and egg situation, right? But government is not going to wait anymore. Government is saying, I'm going to get the data. And then those who are not compliant, those who make property sales and are not declaring, those who are earning income from side hustle but are not disclosing, those businesses that, are so-called in the formal sector, but they are under declaring their taxes, I'm going to have information, and then I'm going to bring all of that into capture within the tax net. Now, the tax reforms covers, it's very comprehensive. It covers, the first wave, covers four laws, but then there's subsequent, reforms that maybe are not contained in the law, but are currently happening. For example, the harmonization of the various taxes at the subnational, the state and local governments is currently happening, where they're trying to streamline the more than 60 taxes at the state level to 9 taxes. So a lot of state House of Assemblies have already passed those laws. So that reform is ongoing. There's also the future state, where all the revenues that accrues to the federal government will be collected by the Nigeria Revenue Service. So, whether it is, shipping taxes payable to NIMASA, whether it is oil and gas royalties, and so on and so forth, all of that will be collected by the Nigeria Revenue Service, so that ministries, departments, and agencies of government are then focusing only on their core, which is to enable businesses to provide licenses, and of course, deal with regulations within their portfolio. While all of those things are happening, there'll be implications for companies in terms of businesses, in terms of their corporate structure, in terms of their value chain. When I say value chain, there are some things that government is focusing on incentivizing, right? Where they have granted tax exemptions, reliefs, and so on and so forth. And then people can take advantage of that. And then it would obviously have implications in terms of people, process, and technology, like I highlighted before. So let's see some important considerations. The first one is Nigerian company. Nigerian company, from a tax perspective, is a company that is taxed on its global profits, right? Now, before the tax reforms, a Nigerian company was simply a company incorporated in Nigeria. That's no longer the case, right? Because some people will set up, companies in Mauritius, set up companies in Cayman Islands or Bermuda without having substance in those jurisdictions. Now, what they have done is to say, well, it's not just incorporation in Nigeria, but if you have your board sitting in Nigeria, which is the central place of management, or if you have your decision making, which is the C-suite, the chief executive, making decisions from Nigeria, then, which is called the effective place of management, then, as long as those things are happening in Nigeria, then it is a Nigerian company. And, if you have a Bermudan company and the board is essentially sitting in Nigeria, or you have a Cayman entity and essentially the decisions are happening in Nigeria, then it's going to be considered a Nigerian company and taxed in Nigeria. I didn't highlight that, when people talk about the discomfort of the tax reforms, many times, I did mention it, that many times it's because of the changes in terms of the intrusive nature of the reforms, right? And it's not new, because in other jurisdictions, government needs the data to be able to do tax administration properly. But government has not really changed a lot of the rates. So when people are complaining the tax reform is going to kill business and all that, government did not change the corporate tax rate. Government did not change the VAT rate. There were changes in capital gains tax rate, which you're going to see now. And there were changes in the personal income tax rate for individuals, right? Those are the two rates that went up. And maybe the royalties for solid minerals business. But apart from that, the rates did not go up. In fact, for VAT purposes, the effective impact is actually net positive to businesses. And I'm going to unpack that later on. So this is one of the cases where the tax rate has gone up in relation to capital gains tax. So if in 2022, you bought a property in Ikoyi for 500 million, right? And then before the tax reforms, you sold it for 1 billion. The capital gain is 1 billion minus 500 million, which is the cost of purchase. So that 500 million, you would have taxed at 10% under the old law, which meant that you would have paid 5 million, right? Or 50 million, 5 million, apologies. So you'd have paid 5 million, right, as capital gains tax. Now, under the new reforms, the rate is now 30%, which means you pay 30% of that 500 million. Sorry, my calculation was wrong before. So which is essentially 30% of 500 million is 15 million, right? So you pay 15 million to government. Yeah. So essentially the rate has tripled, multiplied by 3 in terms of impact. Okay, so this is one of the areas where people, said, well, the impact is really adverse. But if you're doing it as an individual, then you're using the individual rate, not the corporate tax rate. And the individual rate does not exceed 25%. Now, for disposal of shares, there are exemptions. There are 2 ways you can avoid the capital gains tax on disposal of shares. The first one is if the sales proceeds, the amount you sold the shares, is 150 million or below, and the profit is not more than 10 million, then, that gain will be completely exempted. Now, if you're making a return of 10 million out of a proceed of 150 million, it tells me that you're not investing in, your investment decisions are not exactly great. So that exemption, many people, if you're a savvy investor, it doesn't really provide you any cover. But there's another incentive you can benefit from, where if you sell the shares of, say, a Zenith Bank and you make a gain, you can immediately take the full proceeds of that sale and reinvest in, say, a GT Bank. And whatever gain you made on that Zenith Bank sale will be completely exempt from capital gains tax. Okay? So, which was one of the things the reforms tried to communicate, that, really we've increased this for disposal of shares, but people should not be too worried. But, I guess from an investment perspective, people are saying, why do you want to force me to make another investment? Which is a good point, but sometimes government has a policy objective to say, well, we want that liquidity in our stock market, we want that activity in terms of transactions and so on. So we want people to reinvest. If you reinvest, then whatever historic gains you made from previous transactions will be completely exempted. There's a minimum tax for companies as well. But if you're completely domestic, right, and your revenue is not more than 50 billion, then you'll be completely exempted from minimum tax, right? But this minimum tax is actually an improvement on the old minimum tax. The old minimum tax was 0.5% of turnover of your sales, which meant that, if you are loss-making, you could actually pay minimum tax. But under this new rule, you only pay minimum tax if you have a profit and if your turnover is more than 50 billion naira. So it's quite positive as well. However, if your company is part of a multinational enterprise group where the consolidated turnover is more than 750 million euros, then in all instances, you'll be subjected to minimum tax. I wouldn't dwell too much on this one. The other thing to also know from a corporate perspective is that education tax has been discarded. So education tax, information technology development levy, NASENI, police trust fund, all of those things have been harmonized into one development levy. And that development levy will then be shared across all the MDAs that require the funding. Instead of levying 3% education tax, 1% need that levy, police trust fund, NASENI, government has just consolidated this into one 4% development levy. Now, I was telling you that from a VAT perspective, the net effect is actually positive. Now, what do I mean? Every business that makes VATable sales, where you're charging your customers VAT, the VAT on your costs are all recoverable, which means that when you charge your customers VAT, you collect the VAT from your customers, the VAT on your cost, you use it to reduce or set off against the VAT you charge your customers, and you're only paying government the net. Which is why what you will see in the first half of the year, if all economic conditions remain constant, is that businesses' margins would improve significantly. So if I pick the firm which I work for, PwC, as an example, all the VAT on the laptops we purchase, all the VAT on the furniture we acquire, all the VAT on electricity that we pay, right? On power, all that VAT, before the tax reforms, it was an absolute cost for us. Now we get that VAT back. So our margins would improve. But, when government did the simulation, you remember the initial plan was give people the ability to recover their VAT on their costs, right? But let the VAT rate increase. That was the initial conversations when the tax reforms was being debated. It was the governors forum that then said, keep the rate as is. Now, a few people, including the World Bank, have said, if you leave everything constant, government is going to lose maybe 40% of their revenue, because they are going to be giving people the VAT back. One of the reasons why government has then said, we want to see all the transactions that are happening so that we want to be able to say, well, this is a valid VAT claim and this is not a valid VAT claim. And hence, they introduced invoicing, where people have to show or report all their sales to the government's portal. Like I said, businesses with turnover of 5 billion, they're already, implementing. But the second phase, which will start from July 2026 to December 2026, will then cover the next level of companies with annual sales of between 1 billion and 5 billion. When they finish that phase, in 2027, they will then go into the next phase, which is all businesses with turnover of anything up to 1 billion. And by then, all businesses will then be within the fiscal system of the government, and government would have full visibility of all economic activity. Now, tax incentives and areas to focus on. There's something called Economic Development Tax Credit. Now, it's not available to all sectors. It's going to replace what we used to know as pioneer status. So government has identified, some industries, and I'll show you some of them, that they consider to be priority sectors and they want to incentivize. To qualify, there are minimum investment thresholds. But once you make the investment, government will give you 5% back of your investment. So if you do an investment of $100 million, the government will give you back $5 million as profit, right? As a credit. That $5 million, they're obviously not going to give it to you cash. They're going to give it to you as a tax credit, which means you can use it to pay for any taxes that you incur. The other thing is that there is no longer tax holidays, but for a few companies. The two sectors that government has given tax holiday are agricultural, and not all agricultural. It's only primary agricultural produce. So where you're involved in food crops, cash crops, livestock, dairy, and things like that, then you get a 5 years tax holiday on that agricultural business. The other one where you can get 5 years tax holiday is gas pipeline business for gas distribution. You get a 5 years tax holiday on that business. Actually, for gas businesses, you can actually get the 5 years tax holiday plus the 5% tax credit over 5 years. So you can get the 5% tax credit over 5 years, and then in addition, get the 5 years tax holiday. One thing to mention on this economic development tax credit is that if you make a decision as a business that you're not going to be distributing dividends, so all the profits you make, you plow them back into the business, this economic development incentive will be available to you for another 5 years. So you get it for the first 5 years, but you plow back all your profits back into the business, you can get it for another 5 years, which means a total of 10 years. And then zero rating. Zero rating means that you're not charging your customers VAT, but government is giving you the VAT on your costs, which is quite a massive incentive. And I'll show you the businesses that fall into that category. Now, these are the priority sectors. The list is 31 or 32, right? But, I've just put some examples out here in case, it falls into the area of interest for you. Creative industry, production of music, film, TV production, manufacture of pulp, paper products, transportation and infrastructure, agriculture and agri-processing, healthcare, all of these things, you can get that 5% tax credit. And you can get it for over 5 years. If you reinvest, you can get it for another 5 years, right? And I mentioned the two where you get tax holiday. And for gas, you can get the tax holiday in addition to the tax credit. Now, these are, I mentioned zero rating. Now, VAT exempt means you're not charging VAT to customers, but you don't get your VAT on your costs back. But the areas where you don't charge your customers VAT, but government gives you the VAT on your cost back as a refund, these are the industries where you're involved in basic food items. You sell rice, beans, yam, maize, fish, milk, fruits, vegetables. You're involved in, medical and pharmaceutical, whether it's, a hospital or pharmaceutical or diagnostic business, including herbal medicine. You have a school, right? So you're in primary education, secondary, or you have a tertiary institution, then the VAT on your cost, government will give it back to you. Fertilizer business, and so on and so forth. So, these are areas where government is trying to stimulate more activity and investment. Now, impact on individuals. I'll wrap this up in 5 minutes. The rates have changed. The rates are now have now increased for the high revenue earners and reduced for the low income earners. When we did this simulation, what you discover is that anybody who earns per annum 25 million will pay more. Anybody that earns 25 million and less will pay less tax, right? So this is why there were mixed communication in January when payroll was made and people earned their salary. Some people were celebrating. So we saw news clips of people celebrating, say, "Oh, my salary, my take-home pay has improved because of tax reforms," and they were celebrating the tax reforms. And then there were a few of us on this call who were holding our head and say, our income has reduced because our taxes have gone up. The idea from government is that, let the wealthier people pay a bit more and provide relief for the lower income people. So any income above 50 million gets taxed at the highest tax band. And what we used to call consolidated relief allowance, where you get an automatic 20% relief, that has been discarded as well, right? So that's a summary of, now for people in diaspora and expats, it's also important for them to understand how they become tax resident from a Nigerian perspective, because a tax resident is taxed on their global income, their worldwide income, right? A non-resident is only taxed on their Nigerian sourced income. But once you're a Nigerian tax resident, you're taxed on your global income, including the income you make from property in the US, or you make an investment in Bermuda. All of that income is taxable in your hands as an individual. And these are the criteria. The first one is if you have a domicile in Nigeria that is available for you for your domestic use. The other one is if you have substantive and immediate family ties. And then the final one is if you spend more than 183 days in any 12-month period in Nigeria. And these conditions are not mutually exclusive. Once you meet any one of these conditions, you're not a Nigerian tax resident. The incentive outlook for individuals. So it's not all doom and gloom. There are things you can still take advantage of. One of it is voluntary pension contribution. It has always been there. It is still there. Now, what it does is that, every income you contribute to that voluntary pension. So your normal pension is taken, if you're an employee, your normal pension is taken, directly by the company. So the company contributes 10%, they deduct 8% from your salary. You can say over and above that, I still want to contribute. And if you're a business owner, you can say, I still want to contribute. Especially, it makes sense when you're close to retirement because, the rule says that you can contribute that money into your pension and then you can get, 50% after 5 years tax-free, right? The other 50% will continue working for you. But once you reach retirement age, you can withdraw everything. Okay. So someone who has 5 years can just take their full income, drop it in pension, and they get a 25% return immediately. Remember that the tax rate for 50 million and above is 25%. Now, while other people are paying 25%, you keep your whole income 100%. And then in 5 years, you can collect everything plus the return that the pension fund administrator has been able to generate for you, right? I'm sure they will try to plug that loophole, but it's there. The other one is rent relief. It doesn't provide a lot of relief, but I'll mention it anyway, that, if you pay, if you have a landlord and you're a tenant, government can give you a relief of 500,000 naira. If you tell them who your landlord is, you say, my landlord is Olua Hanatu, and this is her tax ID. Government will now say, she's even charging you 10 million naira as rent. Government now has that information and can now tax her. So they'll say, take 500,000 naira back as a relief. Okay, so this is another area where government is going to be using more information to tax people. And between you and me, Lagos State government is looking at this, very seriously. And then work tools and accommodation benefits. So if your company provides you with work tools, those are not taxable. Provide you with laptop, a device, depending on the nature of your job though, right? So if you're in sales and they provide a motor vehicle, then they can say that's work tools. But if that's not your job and they provide you with a benefit, then only 5% of the value of that asset will be taxable. But then there's also accommodation benefit, which is capped at 20% of gross income. So the government can only tax up to 20% of your gross income if the employer is providing accommodation. I've spoken about the capital gains tax as well, but there's also the exemption for the sale of owner-occupied property, right? So if you live in a place and the law did not specify for how long, and you sell the property that you live in your own name, then you get a full exemption for that. But it is a once in a lifetime opportunity. And the law also says that property plus 1 acre of land attached to it. So you can essentially purchase a property in Ibejuleki, build a small house there. Maybe you have 1 acre of land in Ibejuleki. You build one accommodation there. You live in it for, let's say, 6 months, and then you dispose of everything together. Then that full property will be exempt from capital gains tax. There's also exemption of income that is brought into Nigeria as long as it's dividend, interest, rent, royalties. So what government wants is for all those properties and investments you've made overseas, to bring the proceeds back into your DOM account in Nigeria, to help with the FX liquidity pressure. So if you have a property in the US and it's paying you rental income, government says, bring that rental income into Nigeria, we will not tax it. So it's available for dividend, interest, rent, royalty. That's the DIRR. Dividend distributed by mutual funds is exempt. Dividend received from investment in wholly oriented business, export oriented. So if the business only does exports, it's important, if you have a business that does exports and domestic sales, carving out the export business into a special SPV that does only export is actually beneficial because there'll be no dividend withholding tax. There'll be no withholding tax on the dividends paid by that wholly export-oriented business. Federal and state government bonds are also exempt. Now, this is a short investment grid that shows you what is tax exempt, what is taxable by way of withholding tax, which has the F, and then what is normally taxable without any withholding tax. So with that, happy to take questions. Thank you.
Thank you so much, Kenneth. I wish you could see the group chat. Thank you so much. First of all, let everybody, could we just give him claps? He's done a really good job at just breaking it down. And now we have questions. Some funny, but some, very serious. And we're going to start with the first one that came up. That was from Adeyemi when he was speaking about capital gains. He said, must all investment proceeds be reinvested to qualify for the tax exemption?
All right. Good, very good question. If you invest a proportion, you only get the exemption of a proportion. So let's assume, you made the sales, you got 1 billion, let's assume the cost was 0, and then you sold it and you made a profit of 1 billion, for sake of argument, and you only reinvested 300 million. Your exemption of the profit will be 300 million over 1 billion times the profit you made. So that's the way the exemption will work. So you only get a proportion based on the proportion you reinvest. You only get the full exemption if you reinvest the full proceeds in a Nigerian company. And you can reinvest it in a private company. You can invest it in a listed company. So it depends on where you want to reinvest. But you need to have the documentation of how you reinvested to get the exemption. Yeah.
Okay. All right. And the same line, Uzo is asking, trying to understand how the capital gain tax affects individual investors who may not be doing huge volumes on stock purchases. So is there a threshold?
Yeah, so there's a threshold. So I mentioned before that if your proceeds is less than 150 million, yeah, and the gain you made is less than 10 million, that's the level of the exemption that the government has given to, the smaller scale investors. Once you cross any of those thresholds, whether the proceed is more than 150 million or the gain is more than 50 million, then you don't get that protection that the government is trying to offer. So it's just something, it becomes very difficult for a broker, to be fair, to monitor per account of their client, to track it and all that. But, a lot of the brokers, and the people that are involved in, asset management, they know of this exemption, and they should be able to advise you, accordingly if you're using one of them.
Okay, all right. Kane is asking, how do the new laws affect retirees like me whose only income is from rental fees?
Very interesting question. You see, the law, there are some countries where the law actually puts age thresholds for who is taxable and who is not. So in Nigeria, it really doesn't put an age threshold of, so you can actually be 15 years and a dependent and be taxable, right? Because you are doing a thriving business. Theoretically, it's child abuse for someone who is 15 years to be doing business. But, theoretically, the law doesn't provide any cover for a minor, right? Similarly, the law does not provide any exemption for a senior. Senior citizens, we want to respect them and all that, but the guys who drafted the law did not say, as long as you are 80 years and above or 70 years and above, we will not tax you. So where do you get your cover from? You get your cover only from your pension benefits, which are not taxable. But if you have property and you're earning rental income, then that bit is taxable. So it's what it is, you know. I would like to have given you better news, but that's what the law says.
Okay. Okay. And while we're on this issue of rental income, you mentioned, and that drew a lot of laughs in the comment section, the rent relief.
Yeah,
I think from my point of view, the first question is
it's
that
too
even
small.
fair? No, what if I don't like my landlord? So if I
If
don't
you
like
do
my
not,
landlord, if I don't like my landlord, it just means I can go and start reporting him just to get the 500K. But Zainab asked, is the 500K one time or is it annually?
okay. Interestingly, the 500K is a relief. In tax, there's a difference between a relief and a credit. It's not a lot. A relief is like an expense, a write-off you can take in your tax calculation before you now apply the tax rates. So it is not that 500,000 naira is not a lot of money, and you get it on an annual basis. You know, the benefit if you're in the 25% tax band will be 25% of 500,000 in cash terms. Yeah.
Ah, okay.
But you get it every year. Every year you now say, my landlord is Hanatu Adeboyega. You know, they will say, congrats, take the 500,000. So they keep giving it to you because
Mhm.
you've disclosed the information of your landlord. So it's not one time, it's on an annual basis.
Okay.
Now, what if you don't like your landlord? It gives you more incentive to report him. So if you've called the landlord and say, come and fix the door, or the plumbing has not been working, the landlord say, he's not in the agreement or they ignore you, then it gives you more incentive to report the landlord, so that the landlord is nicer. Of course, the other question is, can the landlord then pass the cost to you? Because many of these landlords were not paying taxes before, and government knows. And that's the reason why government is trying to do all of these things, that people, there are many people who earn normal income. There's a particular level you get to as an employee that you now have enough ability to purchase property, not just the one you live in, but the one to get rental income from.
Mhm.
And there was a time in Nigeria where this thing called short lets became, a thing,
Mhm.
and people are so-called cleaning out. And government knows part of the things contributing to the GDP, but there's no tax element to it. So government just wants to try and bring all of that into the tax net.
Okay. Dr. Nami, let me ask this last question on the rent relief. Then, if you have any questions on YouTube, and then I'll go back to a question on e-invoicing. So somebody asked, and I think it's part of the jokes. Is there an election of which of the spouses claims the rent relief? Can both individuals claim equally? So, and all this obviously goes to you don't like your landlord, but it kind of there seems to be a loophole somewhere.
Yeah, there,
So
there seems to be,
you've read
and to be
on.
honest,
Let me ask
I've
a follow-up
never.
question. So
And I'm sorry,
someone
what did you
is
say?
asking, so let me also write on what you're talking about because someone is also asking in terms of couple,
It
how
seems
does
not to
the
be so
rent
clear.
relief? So I'm saying, writing on the question you asked, someone asks if writing a couple, how does the rent relief come for both couples who are the employees of various establishments? So is it coming to only one person or both couples are getting that rent relief together as couples, but they work for different entities?
Very, very, very good question, because to be honest, I've never thought through this question. Um, they say the devil is in the detail. That's what they say. So in tax, very important to go back to the actual provision and read it, which I think I should go back and read. But my initial thought is that they did not anticipate that scenario. So as long as you are resident in a particular location, right? I think both parties can actually claim it, right? Except the wording of the law has been tightened, and I don't remember anything that says only one person should claim it. So it's very possible based on my initial feedback right now, that both the two couples, one will put in their own tax return, the other person put in their own tax return. And government is not worried about that, to be honest. Government knows, that 500,000 relief they're giving to you, which I said is really effectively the 25% of that 500,000, is way lower than the opportunity they will get from the various landlords that own property in Banana Island, Ikoyi, Lekki, Osapa, London, Shangotedo. They know that, if they give the whole Lagos State residents 500,000 naira each, but they have the information of the rental income, that accrues to individuals, they'll be better off. So I think for now, it's a loophole that can be taken by both couples. Maybe in the future, government will tighten it.
Okay. I think the notes from this is be good landlord, so your tenants don't go around exposing you. All right, back to serious questions now. Is the input/output VAT offset immediately available to SMEs who are not e-invoicing compliant?
Okay, very good question, because there's a bit I told myself I needed to speak about, which I then forgot. There's something called a small company. A small company does not pay corporate tax and does not charge VAT. And the threshold is 100 million naira. So if your turnover is 100 million naira, I can't remember the net asset value, it skipped my brain. That is a small company. So that company, whatever profit it makes, it won't pay corporate tax from it. And usually people in the SME space ask me the question, is it better to put your business, register it as a sole proprietor, a registered business name, or should I register a company? If you're not going to be paying yourself the profits from that business, it's actually much better to put it in a company. Okay? Because then, the profit is fully exempt. But if it is one where you're now paying yourself a salary, you've really not achieved much, right? By putting in a company. Because, if it was a sole proprietorship, a registered business name, the profit you would have taxed as an individual in your name, right? But now you've put it in a company and it has been exempted, but you're now paying yourself a salary, which is the salary from the profits. You're still going to tax the profit. So it doesn't really help you much. But from a VAT perspective, it means you don't need to register, you don't need to do the administration, you don't need to charge people VAT. It also means you cannot claim input VAT. But when you cross the threshold, because it's very easy to cross the threshold nowadays of 100 million. I've run a few small businesses myself. Before sales has already exceeded 100 million. Once you cross that 100 million, you need to register, charge VAT, and you do not need to be fiscalized, which means you don't need to be in the invoicing program for you to be able to claim the VAT on your cost right now. It's not a requirement. In the future, government just wants to be able to see that what you're claiming is correct. And the reason why they phased it and done the big companies first, companies with 5 billion and above, is because that is, Pareto's principle. If they miss it for those big companies, then, that's where the real injury will come from. So for now, you can claim your VAT on your costs as a small and medium enterprise without any restriction, even though you've not done e-invoicing.
Okay. You've actually answered the second question from that person. All right, moving on. Are grants given to NGOs or individuals taxable?
Grants given to NGOs are not taxable. Okay? But government is also aware that NGOs and charities can be used as a way of paying people. Now, if there are employees of that charity, right? And I'll give you an example. A church is set up as not-for-profit, yeah? But the church has workers. Those workers, they would pay taxes. The church would deduct pay as you earn on the payroll and pay to government. And if, the pastor gets, a salary, then the taxes are taken from that and paid over to government. Do not forget Jesus Christ saying, give unto Caesar what is Caesar's. It was it was a tax situation as well, where they now had to get a tribute from the mouth of a fish to make that payment. So Jesus Christ paid taxes, However, Nigeria recognizes that there are businesses that have been set up as charities, religious, ecclesiastical, and so on and so forth. Those entities themselves are not liable to tax. So when they get a grant, someone makes a contribution, and all those things, you do not bring it in as income and then take out the expenses and say the business has made profit. Every profit within that not-for-profit entity is exempt, right? It's when they now begin to venture into business, that's when government says, well, this is a venture into outside your objects, then government can then say tax. But just, to simplify it, no, they're not taxable, but the individuals, the employees are taxable.
Just food for thought on that conversation. So if a church decides to have like a bazaar, we would say that's a business. Just something to think about, right? And maybe we shouldn't think, I don't know, it's just, we have a lot of churches. Yeah, so that would be taxable.
A bazaar wouldn't be a business because it's fundraising as well.
Got
right?
you. Okay.
But there is a judicial precedent, and I think it was Assemblies of God, where they had now built an event center. And then they were earning income from that event center. And then the decision of the court was that was a business, the business of property, rental, and all that. And therefore that was taxable. But if it is contribution, what do you call those things? Those tickets that people take out to raise funds, those things are, essentially tax exempt.
Okay. All right.
Which would cover offerings and tithes as well.
Okay. Yeah. Okay. All right. Olusola asks, can you give a practical illustration to explain the distinction between VAT exempt, I'm not sure if you've answered this already, and zero rated, and the importance of this distinction to a business?
Okay, so it's always very difficult to explain this to people that are not tax professionals. And if you remember when Taiwo Yedele, who is the chairman of the fiscal reforms, he struggled to explain this thing. But let me try. Now, before the tax reforms, basic food items were VAT exempt. So what does that mean for me as someone who is in the business of selling vegetable oil? It means that I will not charge my customers VAT, but when I am charged VAT on my cost, I cannot recover it from government. So let's assume I have a heavy cost to buy the machinery to do the vegetable oil. So the person has charged me 100 million naira and added VAT on top of 7.5 million naira. Now my total cost will be 107.5 because government is not going to give me that 7.5% on my cost back. Now, when I am in a zero rated scenario, now basic food items are zero rated, education is zero rated. I will not charge my customers VAT, but when the supplier of the machine is sending me an invoice of 100 plus 7.5, only 100 will be a cost for me. That's 7.5 which they charged me and I paid to them. I will go back to government and say my product is zero rated. Give me back that 7.5. And government will be obliged to give it to me very quickly. In the tax reforms, there's a specialized refund account that has been prepared for VAT purposes. So immediately I go as a school or as a agricultural supplier and say, well, I've paid 107.5 to my customer, to my supplier of this machine. I am entitled to 7.5 back, as soon as I make that application within 30 days, government is supposed to give me the 7.5 million naira back. So that's the difference between VAT exempt, where you don't get the VAT back, and zero rating, where you get the VAT back.
Okay. Okay. There's a question on sale of foreign shares. So is the sale of foreign shares purchased from income earned in Nigeria and repatriated to country included in the tax exemption bracket of DIRR?
So sale of shares is not in the DIRR exemption. It's only dividend, interest, rent, royalties. Those are returns you get on investments. So if you lend money, you get interest. If you're a software developer and you've created this software, you're charging people royalties, or you're a musician, you've created content and you're earning, that is royalty. When you put capital, equity, you put money in a business and the company pays you, makes a profit and declares dividend, that is dividend. So the exemption is for returns on the investment. But if you make a gain on that investment, so you made an initial investment of, $1 million, now there's capital appreciation. It's now $5 million in terms of value and you want to exit. That $4 million will be taxable. You don't get the DIRR exemption. The only way you will get an exemption is if you now take that profit and you reinvest it in a Nigerian company. So you take the $5 million and then you say, oh, there's this GT Bank shares or Zenith, sorry, it's like I've advertised these people a lot. There's this shares I want to invest in, and then you put it in a Nigerian company's shares, then that's when you get the exemption.
Okay. Between Adeyemi and Somsom, I think they're going to have to book some time with you because Adeyemi and Somsom's questions is a whole business case. Somsom, he or she has 4 questions, so I will take 2 and I guess they will reach out to you and probably buy you coffee or lunch and ask the remaining 2. So let's start. I would love to get your insights on VAT and withholding tax treatment for a service company, and then they proceed to give us scenarios. So number 1, when a customer is invoiced for services rendered, we charge VAT on the service amount. However, when they pay, they deduct withholding tax from the service amount and also deduct VAT. How do we treat this in our records?
Okay. Again, it requires that, those sort of explanation that to simplify it, you need to be a tax person. Okay, so VAT is an addition on the invoice. Withholding tax is a deduction from the invoice. Okay? But there are some companies that deduct VAT because government has appointed them as agents to deduct VAT. So ministries, departments, and agencies of government are agents of collection. Banks and telcos are all agents of government to deduct VAT. And then oil and gas companies are all agents. So if your customer is not in that group, then they are not supposed to deduct VAT because VAT is not a deduction, right? They are supposed to pay it over to you with the invoice amount. Okay. So if, for example, you make a supply of 100, you're supposed to charge VAT of 7.5% on top. So your invoice will show invoice amount 100, VAT 7.5, total 107.5. When that customer receives it, they are supposed to pay you the 100 and the 7.5. But sometimes that 100 is liable to deduction of withholding tax, depending on the type of transaction. So let's assume you're a trader and you don't manufacture what you're selling. So maybe you sell laptops. The customer is supposed to deduct 2% from that 100. So they'll pay you 98 plus the VAT of 7.5. So that's what you should see in your account as a credit into your bank account. But if they're an oil and gas company or an MD of government or they're a telco or a bank, they would also deduct the 7.5. So you would only see 98. It's only 98 that you collect in that scenario. So it's therefore important for you to understand the context. In your books, your revenue is always 100, right? The 7.5, when you collect it, if they pay it to you, is a liability because you have an obligation to government. But you can set it off with the VAT on your costs, right? So it's accounting. Credits could either be income or liabilities. So when they pay you, let's assume they pay you 107.5. The 100 is the income. The 7.5 you take to liability. Now they've also taken 2.5, but you've booked 100. There will be another 2% that will go into your asset account as a recoverable because government is supposed to give you a credit against your final CIT. It's very complicated. I think the best way to analyze it is, use Excel, and then I can show you how it works out.
Now, hence why I said they probably have to book time with you.
I'm
But I
telling
will
you, and
ask
I'm very expensive. I have to warn some that I'm expensive, but well, maybe if he takes me to a very nice restaurant, I can be nice, and
exactly.
then yeah.
So it's not something else. But let me ask one question that's probably affecting other business owners here. And it's from Samsung. How can we adjust our pricing strategies to ensure that WAT and VAT deductions don't negatively impact our service amount and cash flow?
Right. So it depends on how you structured your supply to the customer. And how you want to present your financials, to stakeholders. So those are the two important considerations. There are some things that are reimbursables, and if you're able to clearly spell out that those things are reimbursable, separate from your service fee. So let us assume you are in security business. So you provide the security guards and then you charge a service fee on top. And you've agreed with the customer that they will bear the cost of the salaries of those security guards. It's important that on your invoice, you clearly specify the salaries separate from your service fee. If you just say security service and you bundle them together, the customer will deduct withholding tax from everything, which will impact on your margin and your cash flow, right? So it's important that you understand that. There are some people also that in order to boost the way their financials shows their revenue, they're trying to show everything as revenue, right? So for example, you're involved in a transaction where you're a broker. Someone needs supply of pipelines, right? And you're finding the supplier and linking that person up with the buyer. Legally, there are two ways of doing it. The supplier sells to you, and then you sell to the buyer. But there's another way of doing it and saying, the supplier is actually selling to the final buyer, but I'm only a facilitator, so you charge a brokerage fee on top. Now, the withholding tax implication is different for the two, because if you're supplying in your own account as principal, then the 2% will be from the full thing. But if you're saying, well, I'm only a broker, then the cost of the pipelines will be a reimbursement, which the customer is not supposed to deduct withholding tax on. So you can be clever with that.
Okay. We have 3 more questions. One is from Tunji, and he's asking, and it's back to the landlord question. If my landlord operates through an agent whom that's the only person I know, and the agent acting on the landlord's behalf does not provide with his or her tax ID, how can one person proceed with that information while trying to work on getting a TCC?
You can get a TCC even if you're not providing the information of your landlord. I don't think it precludes you from getting a TCC, right?
No, I think you meant getting the tin
the
of
relief.
the landlord.
Okay, the tin of the landlord. So that one is tough. But if you know the name of the landlord, right? and there's some personal details that will be very difficult because what you need to get the tax ID is actually the BVN or the national identification number. Now, if you're struggling to get the tax ID, I'm sure you would also struggle to get the NIN and the BVN because those things are very personal. So it may mean that you lose out on the benefit. I guess what you can do is when you're signing the tenancy agreement, make it a prerequisite because even currently, under current law, when you're going into business transactions, the person is actually supposed to provide their tax ID. It's a legal requirement. So you can mention that to the lawyer, and many times when we go into these tenancy agreements, they'll add agency and legal. Meanwhile, the legal that they are doing is for the benefit of the landlord. So it has always been a landlord's market in this country. But that lawyer should be acting for you as well because you're bearing that person's cost. So I think it's important to insist to the lawyer. The legal requirement has to be followed, which is also provide the details of the landlord. Now that landlord can be a corporate as well, right? There's some companies that are, there are some properties that people put under companies, and I'm working on one of them right now. So the person who will benefit from that information will be the Nigeria Revenue Service, not LRS. Yeah.
Okay, all right. Dr. Lady asks, so why do restaurants collect VAT from customers when the government doesn't charge food business tax? And I had a question in the same vein of when you spoke about the businesses being able to get the VAT back, or, it almost feels unfair. As a customer, I'm paying to you, and then you may not have to pay back, or you might get some level of relief from the government. It seems almost unfair on the consumers.
Yeah. Okay. So very good question. So where government has incentivized is the primary product as against the finished. I wouldn't call it even the finished, because what government has incentivized is the primary product up to where it is still at the basic level. So packaged rice, packaged vegetable, all of those things are exempt. But when you cook the food, there is no I said exemption, zero rated. When you cook the food, it is no longer zero rated. That particular side of the value chain is not incentivized by government. So if you go into a restaurant, already, and maybe not to call it luxury, government considers it to be not the stage they want to incentivize. That's not, where the large population of people that need relief are sitting. So at that level, there will be VAT. But, the restaurants, when they're buying the vegetable oil or buying the beans, it will be zero rated. Okay, so that's the idea. And VAT is considered to be a consumption tax. So what government is looking for is the final consumption. The final consumption of that benefit. That is where they want to take, the most VAT value.
Okay.
So I don't know whether to call it unfair, because that's the way all the VAT regimes are structured across the world, right? And then government has to prioritize who do I want to incentivize. In fact, in some countries, there is now also a higher rate of VAT for what they call luxury items. Nigeria has always tried to avoid it, even though I'm a proponent of that. So private jets. Why would the VAT on restaurant, for example, be 7.5%, and then the VAT on flying private jet would also be 7.5? It should be 15, for example. So those are policy issues that, it has to be debated before the country lands on which course or which direction they want to take. Yeah. And simulate the effect, because again, it's one thing for me to say it doesn't make sense, but when you simulate the effect, you might see that it actually makes sense.
Okay. All right. Two more questions, and one of them is what we'll use to wrap up. How do we, as responsible tax-paying citizens, gain insight into the tax into the tax collected and utilization to hold governments accountable, considering the lack of transparency and the correlation between tax collection and provision of social services and amenities.
This is perhaps the most important question, because after you've done the tax reforms, I think none of us is under any illusions that there is any country that really thrived without clear sources of revenue. Now, the Gulf states are examples of where they've just used resources. We're not as rich as the Gulf states. Let's be fair. Their population is very low, and their oil and gas resources is way more than ours. And even those Gulf countries have started taxation. They've all introduced corporate tax. They've all introduced VAT, even though their rates are actually very low. So for a country to thrive, it needs to collect taxes. However, the big issue is that you do not want the money to enter into what people call voicemail, right? And voicemail essentially means it's going into the hands of a few people, corruption, and so on and so forth. So we need to organize ourselves properly as citizens and be able to ask governments very, questions that will put them under pressure. Now, how do we do that? There are various pressure groups, the various pressure groups out there. There's the organized private sector. And this is where citizens need to then participate. So we have NACIMA, right? Which is like the umbrella body for all chamber of commerces in Nigeria. We have LCCI, which is in Lagos, where I live. We have NECA, the Nigeria Employers Consultative Association. They've been at the forefront of many advocacies in the past. There is also the Nigerian Economic Summit groups. And we as professionals, and many of us in this virtual platform, we have relationships and connections with many of these groups. I don't like bringing church into this conversation, but the church also has a role to play as well. If we all, because let's be honest, we have the population, we have the organization, and we're able to come together and put pressure. The only thing is, let it not just be used for politics. It is just a case of citizens demanding for optimal services from government. So that's the way I think we should approach it.
Okay, all right. And last question, at what time in the year do individuals or companies make tax returns, and how? And I can understand where the question is coming from, where there's tax season in the US. So do we have a tax season in Nigeria?
There was always a tax season in Nigeria. It's just that nobody filed their tax returns. So the tax season is now. It's March, right?
Oh.
On or before 30 days of September, 31st of March. On or before 31st of March is when individuals should file their tax returns. Okay, so as a PwC partner, I've been filing my returns, for forever, right? But everybody is actually supposed to, even if you're an employee, right? Remember, as an employee, you can have side hustle, you can have rental income, and this is what happens in the States as well. If you're an employee, you also still file your return. So you declare everything. So it's important that, people gear up and try to file their returns, because there's a penalty for not filing, which is like 500,000 naira. Yeah. Which nobody wants to pay unnecessarily to government. I'm sure that the Lagos state government, as an example, I know there could be people from other states, would try to work with people to ensure that, this is the first time where people are saying, okay, let me get my filing done. So I'm sure they'll be reasonable and try to support people. But really, the deadline is 31st of March. For corporates, it is 6 months after year end. 6 months after year end, depending on the financial year end of the company, then 6 months after. So if it's December year end, for many of the December year end companies now, by 30th of June, they have to file their returns.
Right.
Now, how do you file the returns? The Lagos State portal is quite friendly. So it will ask you the different types of income, you put it there. It will ask you for the reliefs, you put it there. And then you do your tax calculation and you make the payment. They'll do a desk examination and say, okay, is it reasonable? Is it not unreasonable? And then they'll come back to you. For the companies, you do it on Tax Pro Max, which is the Nigeria Revenue Services portal, where you file the returns. Those are corporate tax returns. There's also the VAT returns. There's the withholding tax returns. Yeah. So you may need to just upskill yourself around that or use a small consultancy to support you in the first instance while you then internalize that function.
Okay. Thank you so much, Kenneth. Thank you so much. Could we please give him a round of applause? Just virtual claps, put it in the chats. If you've learned anything, if this has been of value to you, please let him know that we appreciate the time he's taken to just speak on us and speak to us about knowing our taxes. So, and thank you, Kenneth. You have been honestly really, really helpful. I've learned a bit because I honestly previously didn't understand all this. To everyone that joined, thank you so much for your time. Thank you for your attention. Thank you for your engagement. The questions were fantastic. If anything else, if you've learned nothing, which I doubt, it's not possible. It's not something, the new tax regime is not something, we want to react to in a bad way. We don't want to look at it like something, that's bad. We now have a better clarity on it, right? So it's something you need to understand, anticipate, and just strategically align yourself with this. Our Marketplace Alliance, our commitment is to continue creating platforms like this where, we take the knowledge that we know and find how to just, apply it in the real world. What we pride ourselves is that it's a place where professionals and business leaders come and learn to equip themselves, especially in the constantly changing world that we live in. This webinar is the first one in our series of what is going to come this year. So please look forward for those of you that registered. And if you didn't register, I'm guessing Nnamdi, is there where we can get people that just joined via the link, their emails? Because I know some people just saw the link, the Zoom link, and just joined. So if there's a way, you can please drop your email address if you don't mind in the chat, and we would have that with us just so you know the next time we're going to have another webinar. Next one is scheduled for May, and then we have one every quarter. Please tell your families, your friends, your colleagues, and as somebody said in the last event I hosted, your ancestors. We encourage you to please stay connected. Follow us on Instagram, Marketplace Alliance, just to have more insights and know anything that we have coming your way in this community. We're going to send an email, so we have some post-event resources. Highlights from today. Somebody asked for the recording. I was going to say that's above my pay grade. So Dr. Nnamdi should respond to that. But we will share, if we get approval to share, then we will be sharing the recording. If not, then maybe clips of the recording. So you have something to look forward to. And then we have the feedbacks survey. We would really appreciate if you could fill, just so we can become better and we do this better. Once again, thank you so much, Mr. Erikume. You have been so helpful to us. And thank you, everybody, for being a part of today. Have a good rest of your holiday, and thank you.
Very nice. So the feedback form they need to fill.
Fantastic. Aha. Okay, so it's not just the emails. Yes. And then we have people dropping their emails in. And please, the feedback form has been put in the chat if you want to just click on that and respond. Thank you, everybody, and have a good day.
All right. Thank you. See you in May.
Thank you.
Thank you. Thank you. Nnamdi, is there a way we can copy these email addresses?
Thank you.
Thank you. Ofa, is there any way you can copy the email address so we don't lose them? Oh, I guess we'll have the messages.